Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, March 20, 2017. You're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. All in all, we had a relatively quiet day, as we normally do on Mondays, and the market obviously has been relatively quiet of late. Even though we've edged down for the last few days, it's on light volume and there's not a lot of intraday activity going on. However, there are a couple of things that catch my eye, so I want to bring them to the forefront. We'll discuss them tonight. I have a pretty good indication that tomorrow should be a bigger mover than we've seen of late. Whether it's on the up or the downside remains to be seen. Right now, I am favoring the downside. I think that I'm right in that this is a potential ABC pattern developing in the market. And what I mean by that is the A leg down, the B leg, a rally back higher, making a higher low, a lower high. And a lower high is generally a sign of more downside coming. And that's what my expectation is. And there's a couple of reasons why. I think the market's going to move tomorrow one way or the other. But there's a couple of reasons why I think the downside is favored. Before we go over that, if we were to go up tomorrow, we would most likely want to make a run for the gap that was left open from the other day, from Thursday to Friday. That comes in at about 238.40, and that represents roughly about 16 points in the S&P, or about $1.60 or so in the SPDR. So keep that number on your radar screen. We should find a fair amount of resistance at that level. And that's, of course, provided that we do have somewhat of a rally tomorrow. If we have the other side, the mirror image of that tomorrow on the downside, which that is what I'm favoring at this point in time, here's what we have to watch out for. This pivot low from the 9th of March comes in at 235.74. That's going to be a line in the sand from an intraday perspective. We should find some support at that level if we head lower. And if we break that level and begin closing hourly below that level, we could have a pretty decent sell on our hands. Maybe not all tomorrow, maybe not all in one shot, but that should be the beginning of the extension of the C leg that I'm talking about. So that C leg, in order to complete, really needs to come down a little bit more, and the likely scenario is that if we get any kind of major selling in the market and we do come below that level at 235.74, I think that's what it was. Let me just double check. I've already forgotten it. 235.74. If we come below that low level and close certainly the day below that level, then we're likely scenario is we take a pretty quick shot down to the 50-period moving average that comes in around 232.34, right in this zone here. And we can obviously go lower all the way down to this level here around 228, maybe even 229, 230, in that neighborhood. That is and remains a possibility if we get some selling pressure in this market. And that, in effect, would end up working off the overbought condition that I've been mentioning for the last several sessions or even couple of weeks at this point. So I put a line on the chart, 235.74. That's the number that should act as intraday support. And if it breaks and we begin closing hourly below that number, then I think the selling pressure will intensify, as it's my opinion, and it's really more of an opinion, that's where the institutions will start sell programs, and that'll scale the market lower. The volume should pick up at that point, and that's at the point in which people will get scared out of the market and rush for the exits. And when everybody rushes for the exit at the same time, that's when the selling pressure intensifies. There's a couple of other things I want to mention, and they're part and parcel to the reason why I would favor the downside. Let's take a look first at the XLF, which is the Financial Select SPDR. Now, a few days ago, we flagged this bear pattern, okay, and it's certainly playing out. And from a symmetry perspective, this pattern is pretty much done. However, that's not to say the market can't go lower. I'm just saying, as far as market symmetry is concerned, if there's going to be any with this pattern is basically done. Maybe it comes down to 24, which is only a quarter less than we're at now, into the 50-period moving average. But if the market is selling, then certainly the XLF and the financials are going to come down farther. But this is the reason why I wanted to make mention of it. And I've said this a number of times. Without the financials, the market has a very difficult time, and it's very unlikely that we stage any kind of a rally without financial participation. Now, I want to take a look at the 4 financial sector bellwethers, and we'll start with JP Morgan. So JP Morgan, you can see this, very much a mirror image of the Spider XLF, and it's coming down. It had a bearish pattern, and this doesn't look like the market looked of late. It certainly has been weaker than the overall market for the last several sessions, minus today and maybe Friday, but certainly was making a bearish pattern, and that's something that we need to watch out for, and that's why I kept pointing out the XLF to you guys. And so let's look at something else, which is the 10-minute chart, because I want to show you what happened at the end of the day. At the end of the day, the last 20 minutes of the day, we really started selling in JP Morgan, and that's generally a sign of more selling pressure to come leading into tomorrow. What would be the other reason why they were dumping JP Morgan into the close, unless somebody out there, quote unquote, believed that there was going to be more selling in the market tomorrow? Again, the financials are generally market leaders on the up and the downside of the S&P and the major indexes, right? So without the financials, very hard for the market to sell. Let's look at another one. We'll look at Goldman Sachs, okay, another financial bellwether, okay? Perpetual sell today, a little bit more of a sell into the close. So that's a little ominous. Okay, we're holding this pivot low, however, certainly weaker. And when you look at the daily chart, this has certainly been under pressure of late. We closed below the 50-period moving average today. That's never a sign of a positive market. It's generally a sign of a negative market in the short term. Definite pressure in the financials. Another one, Wells Fargo. You can see here, Wells Fargo selling. Obviously looks very similar to the XLF, headed towards the 50-period moving average. When you look at the 10-minute chart, this one's even worse than the other two, and you can see what happened at the end of the day today. Put in a pretty hard sell in Wells Fargo, and that's generally a sign of more to come when we sell at the end of the day like that. And look at the volume in comparison to the rest of the day. 1.5 million shares in the last 10 minutes of the day. Look what happened the rest of the day. Barely, 400,000 shares for the remainder of the day or throughout the trading day. So this is telling me that there's pressure coming in the market at the end of the day. That's generally not a good sign leading into tomorrow. Last one we'll look at is BAC, or Bank of America. Similar routine, selling into the end of the day. So this is what I'm watching. I'm watching the financials today, very, very weak. The financials have been weak. Without the financials, very hard to imagine the market staging any kind of a rally unless the financials stage a rally. If they do, then all bets on the downside are off. But if they continue selling, I have to believe that the market is kind of teetering right now in a very critical area, meaning the Spider or the S&P is teetering on a very critical area, and it's going to be make it or break it time, and tomorrow, in my opinion, is the day. And what I mean by that, it's the day where we're going to get a move in either direction. Either we're going to recover and we're going to rally tomorrow, or we're going to see more selling pressure. I don't think we're going to see a quiet market tomorrow. I think tomorrow we're going to see an increased movement, increased volatility if it's to the downside. If it's to the upside, we certainly can float higher on light volume, but I think we're going to get the move one way or the other tomorrow. All right, let's go to our other leading indication or leading indicator of the market, which is the IWM, not the other. It's our primary leading indicator of the market. And I'm going to go over to the daily chart. Bear with me. Similar in concept to the spider, which is making a lower high. So we had a down move, put in a pivot low, rallied a little bit. That's working off some of the short-term oversold condition, normal garden variety behavior. We rallied up a little bit, and if this is going to be a lower high, then the next move is generally going to be like that, and that's your ABC pattern or your zigzag pattern, as some books will have you believe. Doesn't really matter what we call it, but this is what my expectation is, unless and until we can stage a better rally and get back above an important number, which is 138.82 on a daily chart closing basis. Now, how would that happen based on where the market is now? Well, certainly the other or the alternative is that we can go sideways for another couple of days, or maybe even tomorrow we shoot up. That's possible. If we can gap higher and gap above that number, then we can rally. But this could put in a sideways pattern and rally. That is possible. Or, like I said before, if my expectation is correct and we're going to get the move one way or the other tomorrow, then we could get the move on the upside, and we can certainly gap above the 138.82. That's an important number for the IWM. One other thing I find interesting when I compare the IWM on the hourly chart with the spider, and this is generally a good indicator of what the next several hours will bring, and this, in this case, leading into tomorrow, you can easily make a case with the IWM that this is a bullish pattern. So I want to give you both sides. So here we have a potential bullish pattern. We're trading around the 200 period moving average. That would be the 200 hourly moving average. And it's holding. So this could certainly be setting up for a move higher. But there is a divergence. And the divergence is found when you compare the IWM to the spider. The spider is not making a bullish pattern on the hourly chart. It's actually edging lower, and what we've done is we've come into the 236.50. That's an important number. We've been trading in and around this number. We've been beating on this number for quite a while in the spider, even though, believe it or not, Friday we paid a dividend, which was $1, and so we're $1 lower without the dividend or with the dividend than we normally would be. And yet we still respected the 236.50 on the almost on the dime today, making a low of 236.32. And I find that interesting for nothing else than, even with a dividend, the market still found support at the important 236.50 that we've been watching for quite some time. However, as you know, the more we beat on a number, the less likely we are for that number to hold, the more prone that number is going to be to break. So we'll see what happens, but let's go back over to the IWM. That's where we were. I don't want to jump around too much. So on the hourly chart, it's a bullish pattern. On the daily chart, I can make a case that it's making a lower high, and without the lower high, you could certainly put in a bullish pattern out of this move here, this up move, bullish pattern. So there is a little bit of a divergence that we certainly want to be aware of. So I like to give you both sides. But today, the IWM was the weaker index, being down 0.5%, and the spider was only down basically 13 basis points, or just more than 0.1%. So the spider didn't move all that much. It was down 30 cents, but the IWM was down 0.5%. So that's generally telling you something, and we're going to take our cues from the IWM. We'll see what tomorrow brings. My bias is to the downside. Heading over to the transports. Now we're edging lower in the transports, and if you remember, I've been mentioning that 9,000 is going to be an important level for the transports. It's actually about 89.75. It's this pivot low here that I've got, I'm sorry, this one here that I've got my eye on. at 89.80, okay? So 89.80 is really the line in the sand for the transports. I'm going to put that on the chart. You know, from a short-term perspective, you can see this big green up candle, well, big relative to the next three candles, and the low of this candle is 9,081.76. So if we close below that, then the likely scenario is we come right into the 89.80 level, and if the market's selling hard, we'll break through it and scale lower. But that's what I'm watching. That's an important level. So far we're holding that level, but we'll see what happens over the next day or so. Transports, similar to the IWM, down 0.5% today. So my two favorite leading indicators, down 0.5% today against the other markets, and that's generally telling us that there's more selling at hand. No trouble whatsoever today in the NASDAQ. If you want to take a look at the NQ chart, I mean, this is just all out bullish, nothing wrong. Nothing on the chart tells us that this market is going down whatsoever. Doesn't mean it can't if the spider goes down or the S&P goes down, as does the NASDAQ as well. Only right here, right now, this is in a very, very bullish position. And you know how I feel about this index. It's too top heavy and it's too closely weighted to the, you know, the large tech names, the Googles, the Amazons, the Apples. And so when you have things like that weighting the index, that are the hedge fund darlings, the mutual fund darlings, everybody owns them, nobody wants to sell them, it tends to have a skewed impact on the index, and that's why I don't love to use this index for a leading indicator one way or the other. All right, let's head over to the gold market. Gold was higher a little bit today by a few bucks. And if you remember from last week, I said we're kind of in that zone at about that 1235, 1238 area where we'll likely stall out and need to pull back. Well, we haven't seen a pullback yet, but certainly if the market, meaning the stock market, is going to sell off, there could be a scenario where we could see higher prices in gold. We could see it go in either direction. However, I don't like to tie the markets together. You know how I don't like to use correlations or even negative correlations or positive correlations, but we should stall out here. We had a pretty decent rally from the lows down in this zone, and it's generally a pretty good bet that the market stalls out around the 50% 618 retrace from high to low, and from this high to this low, we've retraced about 50%, approaching the 618 in that neighborhood. That's about where we are. So when you look at that and you say, well, it makes sense that we would stall out, but that doesn't mean that we have to sell off with any magnitude. We could certainly go sideways and just go back and forth for a few days, and that would satisfy the working off some of the short-term overbought condition, setting up for another move higher. So that's where I stand in the gold market today. And by the way, any pullback that we do see or sideways movement that we do see would normally be setting up at this point in time for another leg higher. So I'm not looking to sell gold. I'm looking for an entry point to buy gold on any kind of a pullback. We come down to 1220, 1222 in that neighborhood, 1219 in that zone. That would be a buying opportunity, in my opinion, for the gold market. Looking over at silver. Same routine in silver, same discussion we just had with gold can be applied to silver, looking for either sideways for a few days or a pullback to buy, not looking to sell silver, looking for an opportunity to get long. If I want to be long silver, you want to be long on a pullback, but this is in the general area where we should begin to see another leg higher shortly. Heading over to crude oil. Crude remains under pressure. We've been discussing the fact that if we can't get above 50 and a quarter, then we would likely see more selling pressure in crude oil. And that's what we saw today. We didn't see a whole lot of selling pressure in crude oil, down 41 cents right now. However, likely scenario is that if we do see more selling pressure, then we're going to come all the way down to a 45 and maybe even lower down to $44 a barrel in crude. What we had here was a severely oversold, a short-term oversold condition. We're working off a little bit of that oversold condition, but I got to tell you, it's not doing a very good job of bouncing much higher off that condition, and that tells me that crude is very weak and setting up for another leg lower. At 45 or even $44, that's going to present a pretty good buying opportunity around the energy complex. What I'm looking at right here is the XLE, and you can see the XLE right here putting in a bearish pattern underneath the moving averages, underneath the 200 period moving average, and you can see the 50 and the 20 period moving averages sloping down. That's generally a sign that it wants to go lower. I'm looking for this zone here, 68, 67, in that neighborhood for a potential buying opportunity if we can match it up with crude oil down at that $45 area or slightly lower. If we can match that up with 67, 67 and a half in XLE, or maybe even slightly lower, that would be a good match for me. That would present a buying opportunity for the XLE, which contains your large integrated oil plays and others. Heading over to the U.S. bond market, the 30-year bond. Last week, we talked about the bond market stalling out around this number. I thought it would even stall out a little bit lower, around the 20-period moving average. We closed above that today. This tells me it wants to get to the 50-period moving average at 149.22, give or take. There's a little consolidation here, pivot high. There's going to be some resistance in this zone, but if in fact we are getting any kind of a sell in the stock market, you can look for the bond market to stage a rally, and we may even be able to get above the 50-period moving average. I just want to go over to the weekly chart for a second and refresh something that we discussed last week, which is we came in and finally touched the 200-period moving average. Now, at the time, I wasn't 100% sure that was going to hold since we consolidated above it. Now, we're still consolidating on a weekly basis above that moving average, and you can see here we're coming into the 20-period moving average on the weekly chart, or the 20-week moving average, so that should provide some level of resistance. Now, since it's a weekly moving average, we can pierce through that a little bit intra-week, but it's going to be important to see where we close the week. If we close the week above this high here, which is at 149.30, that's going to clear the way for higher prices in the bond market. Now, it's not out of the woods at that stage of the game. However, it certainly is more promising than we were down at the 200-period moving average. Still a lot of work to do in the bond market to get up to the 159.60 area that I've been discussing. However, when you look at this, this is a bearish pattern. So there's a lot of work to do to stage that rally up to this zone that I've been discussing, 159 to 160. That's the zone that we've been talking about. However, we're going to have a lot of work to do to get clear all this. We really need to get above 152.23 in order for that to happen. But we're on the way. It certainly is trying, and we're certainly trying to trade away from the 20-period moving average, which is a positive for the bond market at this point in time. But not out of the woods just yet. And remember, a couple of forces working in the bond market. If we have a sell-off in the short term, it's not uncommon for us to see a rally in the bond market also at the same time in the short term. However, I don't expect the 159.60 in the short term. So what my expectation really is that we may banter around for a while the stock market really should continue a rally into the summertime. Even if we have a sell-off in the short run, that shouldn't be the end of the rally. We could still have higher prices in the stock market depending on where any sell-off would go to and what happens after that. It's way too early to tell. But in the second half of the year, that's when my expectation is that we could see that 159.60 in the bond market, and that would coincide with more of a sell-off in the stock market, but that's in the second half of the year. So I just wanted to make sure that everybody's clear on that. Last market we'll cover tonight is the US dollar. Dollar didn't really do much tonight. I'm going to stay pat with what I've been telling you, and my expectation is for an A, B, lower high, C rally to continue. This is the zone we're looking at, down somewhere in this neighborhood. That's where we're going to be looking for a reversal signal in the dollar for the next leg higher, all the way back up to 105 and beyond. So nothing's changed as it relates to the dollar. We just put in a nothing day today in the dollar, not reading into that one way or the other. And with that, we're going to give it a wrap tonight. It's everything I intended to discuss. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.